Well, hello and welcome to this afternoon's webinar, Master Market Sentiment with AAII's new dashboard, led by Wayne Thorp, Head of Research and Analysis here at AAII. And thank you so much for joining us. We are happy to have you all here. My name is Jennifer Shear, and I'll be your host for today. We're really glad that you chose to be here with us this afternoon. But before we begin, there are a few things I'd like to go over. So I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. The information that we share during the presentation today is for educational purposes only. And then be sure to keep an eye on the chat throughout the webinar. We'll be sharing helpful resources, some key insights on how to interpret and apply sentiment data. And then we've also put together a great set of materials that we'll email to all attendees later this week, so you'll have them handy whenever you need them. And then if you have any questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And then once our presentation concludes, I'll select a few for Wayne to answer. And then if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. You can find the presentation slides in the handout section of your GoToWebinar control panel, also located on the right-hand side of your screen. Feel free to follow along using the handout. It will also be emailed to all attendees after the webinar. And if you experience any issues with the audio or the video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. I will also put it in the chat, some helpful resources in case you run into any issues. And then just a friendly reminder that this presentation is recorded and a replay of the webinar will be sent to all who attended today. The PDFs and recording will also be accessible at aaii.com/webinars. For new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to Wayne.
Thank you, Jenna, and welcome everyone to the Sentiment Investing Open House. I'd like to especially welcome the early adopter subscribers to Sentiment Investing who are watching today, as well as Platinum subscribers who are enjoying this powerful addition to their suite of tools and portfolios. I'm Wayne Thorp, the lead creator of Sentiment Investing. I want to start off by asking you all this question. Have you ever bought a stock near its peak because everyone was talking about it, or sold at the bottom when the news felt overwhelming? Well, don't worry, you're in good company. Even legendary investors fall prey to this. The difference is, the best investors have learned to recognize these moments and use them to their advantage. Here's what we know. Markets aren't perfectly rational. They're driven by human emotions: fear, greed, euphoria, panic. These emotions create predictable patterns that swing between extremes. The challenge is that most investors get caught up in these emotional waves instead of riding them strategically. And while everyone focuses on fundamental analysis and technical indicators, they're ignoring one of the most powerful signals available: market sentiment itself. Today, I'm going to show you how to harness market psychology as a tactical tool, not to replace your investment strategy, but to enhance it. Not to time every market move perfectly, but to improve the odds when the crowd gets it dramatically wrong. This isn't about becoming a day trader or abandoning sound investment principles. It's about adding a sophisticated layer to your investment process, one that helps you be a buyer when others are sellers and cautious when others are reckless. By the end of this presentation, you'll have a better understanding of how to read market sentiment, use psychological indicators to make tactical portfolio adjustments, avoid the emotional traps that derail most investors, and turn market psychology from your enemy into your ally. This slide shows you exactly what I'm talking about. This is real data from AAI members, your peers, during two of the most critical market moments of the past 25 years. In March 2000, at the absolute peak of the dot-com bubble, AAII members on average had 77% of their portfolios allocated to stocks. They were buying into the euphoria, convinced that this time it was different. Fast forward 9 years to February 2009, during the depths of the financial crisis. Those same members had slashed their stock allocation to just 44%. They were selling at the bottom, paralyzed by fear and negative headlines. That's a 33-point swing in the wrong direction. Buying high, selling low, the exact opposite of what we know creates wealth. Now, these aren't unsophisticated investors. These are AAII members, people who care enough about investing to join an investment education organization. They understand the fundamentals. They know the theory. But when emotions ran high, they made the same mistakes everyone else makes. Here's the thing. Even if you're a long-term investor, you're still making buy and sell decisions. You may be dollar cost averaging or rebalancing. But what if, during these critical moments, we had a framework to help us recognize when our emotions were driving us towards poor decisions? What if we could transform those inevitable portfolio moves into informed, tactical choices instead of panic-driven reactions? That's exactly what sentiment investing does. It doesn't eliminate the human element, it harnesses it. Now that you've seen what's at stake, let me walk you through exactly what we're going to cover today in your journey to better market intelligence. First, we'll explore why market psychology drives investment outcomes. Not just the theory, but the actual mechanics of how emotions move markets and create the opportunities that disciplined investors can exploit. Then I'll show you how AAII has been measuring sentiment for the past 37 years, the longest running individual investor sentiment survey in existence. This isn't academic theory. This is real data from real investors like yourselves, collected every single week since 1987. Next, we'll dive into the complete sentiment investing dashboard, your command center for reading market psychology. You'll see exactly what indicators to watch and how they work together to give you a clear picture of market emotions. We'll also cover our AI-generated historical pattern recognition system that identifies when current sentiment conditions match previous market turning points. Think of it as having decades of market wisdom at your fingertips. Most importantly, I'll show you how to integrate all of this into your existing investment process. Because remember, this isn't about replacing what you're already doing well, it's about making it better. And finally, we'll wrap up with the subscription details and an exclusive webinar offer to those ready to take the next step. By the end of today, you'll have a complete framework for using market psychology as your tactical advantage. But before we dive deeper, I want to get a sense of where you're at right now. So let's do a quick poll. What's your biggest challenge when markets get volatile? Now, Jenna is going to deploy this poll it's going to appear on your screen, and feel free to vote. But let's talk about this poll. Is it keeping your emotions in check? We've all been there, watching your portfolio swing wildly and feeling that pit in your stomach telling you to do something, anything, even when you know you should probably just be sitting tight. Maybe it's knowing if or when to act. You see the market dropping or surging, and you're not sure if this is the moment to make a move or you're just being reactive. Perhaps it's finding reliable signals. There's so much noise out there. Talking heads on TV, conflicting analyst reports, your neighbor's hot stock tip. How do you cut through all of that to find information you can truly trust? Or is it understanding market context? You know something is happening, but you're not sure what it means for your portfolio or how it fits into the bigger picture. Or maybe it's all of the above. You're dealing with emotional stress, decision paralysis, information overload, and confusion about what it all means. Take a moment to think about which one resonates most with you, because everything we're going to cover today is designed to address these exact challenges. The beauty of sentiment investing is that it gives you a framework to handle all of these issues systematically. So let's see where we land, and then I'll show you how you can use sentiment data directly to address whichever challenge you're facing most. We'll just take a minute as Jenna maybe compiles our results and we can see how people voted.
All right, we have about 75% voted, so I'm going to close the poll and we're going to share the results. So we're seeing about 42% of all of the above. Runner-up is the 27% knowing if or when to act. 16% says finding reliable signals. 9% said understanding market context, and 6% said keeping my emotions in check.
Excellent. Well, that's an excellent cross section. I appreciate and thank everyone for participating. So now we have a good sense of what people are thinking about as we head into the meat of this presentation. Now let's get to the heart of why those challenges you just identified are so universal. It comes down to this simple truth. Markets are human and humans are emotional. Let's look at what's happening around the brain in the center of this slide. We have fear and greed overriding rational analysis. Many of you know this feeling. You've done all your homework on a stock, but when it starts dropping, that pit in your stomach makes you want to sell regardless of what your spreadsheet says. There's herd mentality. Following the crowd feels safe, but it often leads to terrible entry and exit points. Think about how comfortable it felt to buy tech stocks in 1999 when everyone else was doing it, or how reassuring it felt to get out of stocks in 2009 when your neighbors were doing the exact same thing. We have 24/7 media amplification. Every market move gets analyzed to death. Every piece of news gets spun into either the end of the world or the next big opportunity. The constant noise makes it nearly impossible to think clearly. And here's the kicker. We have no objective measure. Without data, emotions drive our decisions. We make choices based on how we feel rather than what the evidence shows. This isn't a character flaw, it's human nature. The problem is that these emotional patterns are predictable and cyclical. Fear peaks at market bottoms, greed peaks at market tops. The crowd is most confident right before things go wrong. But here's the opportunity. If these emotional patterns are predictable, they can be measured. And if they can be measured, they can be used as a tactical advantage. That's exactly what sentiment investing does. It gives you an objective measure of those subjective emotions. So this slide shows you what crowd psychology looks like in the real world. Market sentiment isn't some abstract concept. It's crowd psychology in action, and it creates the same patterns over and over again. Look at the 2020 COVID panic. People were hoarding toilet paper and selling stocks in exactly the same panicked mindset. It's the same psychology, just applied to different assets. When fear takes over, rational thinking goes out the window across all areas of life. Then we swing to the other extreme. Bull market FOMO, fear of missing out. Crypto hit $69,000, tech stocks trade at 40, 50, or 60 times earnings, and suddenly everyone's a genius investor. Euphoria looks the same everywhere. Your barber is giving you stock tips, your Uber driver is talking about his day trading profits. Sound familiar? And when reality hits, we get crisis capitulation. The 2008 bank runs created the exact same psychological pattern we saw in March 2020's market selling. Different crisis, identical fear response. Now notice the wave at the bottom of the slide. This is the emotion cycle that drives markets. Fear to greed and back to fear. It's as predictable as the tides and just as powerful. Here's what most investors miss. These aren't random events. They're the same psychological patterns repeating throughout history. The players change, the technology changes, even the specific assets change, but human nature stays exactly the same. The opportunity comes from recognizing where we are in this cycle before everyone else figures it out. When you can measure sentiment objectively, you can stop being a victim of these cycles and start using them strategically. Now, here's the critical distinction between understanding sentiment and actually using it profitably. Most people think sentiment is useful all the time. It's not. Sentiment readings become actionable only at extremes. Think about it this way. If sentiment is neutral, it's not telling you much. When 40% of investors are bullish and 35% are bearish, that's just normal market chatter. But when sentiment hits extremes, that's when you have your opportunity. Bullish extremes are when everyone's euphoric, when sentiment readings show overwhelming optimism. But these are your warning signals. When 60% or 70% of investors are bullish, that's when you want to be cautious. Maybe take some profits, or at least stop adding aggressively to positions. Bearish extremes work the opposite way. When sentiment crashes and everyone's terrified, when only 20% of investors are bullish, that's often your buying opportunity. Remember our AAI members in March 2009? That was a bearish extreme, and it was the best buying opportunity in a generation. However, what separates professional sentiment analysis from guesswork is statistical significance. You need to know when these readings are truly extreme versus just everyday volatility. With 37 years of AAI data and deep historical data on other key market sentiment and valuation metrics, we can tell you exactly when sentiment reaches levels that have historically mattered. Most importantly, you need to know when you've actually hit an extreme, not when it feels extreme to you, but when the data shows is extreme relative to history. That's the difference between emotional reactions and tactical decisions. So let me show you what true extremes look like and why they matter so much. March 2009, 70.3% of AAI members were bearish. That's the all-time record in 37 years of data. Think about that for a moment. 7 out of 10 individual investors had basically given up on stocks. The headlines were apocalyptic, everyone was talking about another Great Depression, and it felt like the world was ending. But that extreme bearish reading coincided almost perfectly with the market bottom. Bearish sentiment peaked on March 5th, 2009, and the S&P bottomed out on March 9th. Following that, the S&P 500 gained over 60% in the next 52 weeks. Skip ahead to March 2020. We experienced extreme fear again, with the VIX spiking to almost 83, a level of panic we rarely see and the highest it's been since the beginning of 1990. The VIX peaked at 82.69 on March 16, 2020, and the S&P reached its low 1 week later on March 23rd. Just 20 days later, the index had jumped more than 22%. While everyone was focused on the health crisis, the sentiment data was screaming opportunity. Those who recognized this extreme and acted on it caught one of the fastest recoveries in market history. Here's the pattern recognition that's so powerful. Extremes often mark inflection points. When emotions reach breaking points, either euphoric highs or terrified lows, markets tend to reverse course. It's not magic, it's mathematics. When everyone who's going to sell already has sold, who's left to push prices lower? But here's the key insight that separates successful sentiment investors from everyone else. Objective data beats emotional reactions every single time. In March 2009, if you were relying on how you felt, you probably wanted to sell more stocks. If you were watching the news, you were probably terrified. But if you were watching the sentiment data objectively, you knew that this was likely a historic buying opportunity. That's the power of having a systematic approach to reading market psychology. Now let me show you the statistical proof of why sentiment extremes matter so much. Again, this is 37 years of data, nearly 2,000 weekly observations, and the numbers are striking. Look at bullish sentiment first. In almost 4 decades of data, we've only seen bullish sentiment reach 3 standard deviations above the mean 5 times. 5 times in 37 years. These were moments of absolute euphoria. January 2000, right before the tech crash, late 2001, and a few instances in 2003 and 2004. What happened next? The average 1-year S&P 500 return was less than 1%, essentially flat when the average annual return is around 10%. When everyone was most optimistic, the market went nowhere. But here's where it gets really interesting. Even at a less extreme, 2 standard deviations above the mean, we've only seen this 63 times in 37 years. That's just 3.2% of all observations. In other words, extreme bullishness is genuinely rare. Now flip to the other side. When sentiment crashes to 2 standard deviations below the mean, extreme bearishness, we've only seen this 18 times. That's less than 1% of all weekly observations. Most recent was April 27, 2022, right when everyone was panicking about inflation and rate hikes. What happened after those 18 extreme bearish readings? The average one-year S&P 500 return was 18.1%, nearly twice the historical average. This isn't theory. This is mathematical proof that sentiment extremes create predictable opportunities. When investors are most fearful, future returns are highest. When they're the most euphoric, future returns tend to disappoint. Now let's look at the other side of the equation, extreme bearish sentiment. And this is where the opportunity really becomes clear. When bearish sentiment reaches 3 standard deviations above the mean, meaning an extreme number of investors are pessimistic, we've only seen this 7 times in 37 years. That's less than 0.4% of all observations. In this case, the most recent was September 28, 2022, right when everyone was convinced we were heading into a major recession. What happened after those 7 extreme bearish readings? The average one-year return for the S&P 500 was 24.5%, more than double the historical average. When investors were most terrified, the market rewarded those who stayed disciplined. Even at the less extreme level, when bearish sentiment was 2 standard deviations below the mean, we've only seen this 12 times since 1987. The last time was January 15th of 2004, during a period of unusual investor confidence following the Nasdaq's 50% gain in 2003. What followed those 12 instances of extremely low bearish sentiment? An average one-year loss of 7% for the S&P 500. When almost nobody was worried, that was actually the time to be cautious. Think about the asymmetry here. Extreme fear creates 24.5% average returns, while extreme complacency generates 7% average one-year losses. The data is telling us when to lean in and when to pull back. This isn't gut feeling or market timing. This is statistical evidence that sentiment extremes create predictable, profitable patterns. The VIX gives us another powerful lens for reading market psychology, and it perfectly complements what we just saw with the AAII investor data, sentiment data. Let me quickly explain what the VIX is and why it's such a powerful sentiment tool. The VIX, or fear gauge, measures how much volatility the options market expects in the S&P 500 over the next 30 days. Think of it as Wall Street's anxiety meter. When investors are terrified, they'll pay huge premiums for insurance against market drops, driving the VIX sky high. When they're complacent, nobody wants to pay for protection, and the VIX plummets. Here's what 35 years of data reveals. The VIX works brilliantly as a contrarian indicator, but only in one direction. When fear spikes and the VIX hits 30 or higher, it's screaming, buy the panic. We've seen this 734 times since 1990, less than 1% of all daily readings over that time, with the average one-year return of 22%. When extreme panic pushes the VIX above 40, the results become even more dramatic. 34% average returns with a 97% success rate. But here's the rub. Low VIX doesn't work in reverse. When the VIX drops below 12, signaling extreme complacency, forward returns barely exceed the market average. Markets can cruise along with low volatility for months without meaningful corrections. Why this asymmetry? Fear hits like lightning. Investors panic and create explosive VIX spikes that reliably mean revert. But complacency builds like molasses and can persist indefinitely. The VIX has a hard floor at 0, but no ceiling. Recall the VIX peak in March 2020? It jumped from 17.08 on February 21st to 82.69 in 16 trading days, a 384% spike. And before then, the VIX had not moved above 21 in 131 trading days. The investment implication is clear. Buy the panic, ignore the calm. When the VIX rockets above 30, history shows this creates exceptional buying opportunities. But don't try to time market tops using low VIX readings. Now let's look at a third powerful sentiment indicator that rounds out our toolkit, the ARMS index, also known as TRIN. While the AAII Sentiment Survey reveals what individual investors are thinking, and the VIX indicates institutional fear levels, the ARMS index captures something different. It measures the actual flow of money in real time by comparing the trading volume of advancing versus declining stocks. When TRIN hits extreme highs of 2.83 or above, it signals panic selling. More volume is flowing into declining stocks than advancing ones. This creates an exceptional buying opportunity with average one-year returns of 16.7% and a 95% win rate. But here's what's fascinating about TRIN compared to some of our other indicators. It also works well at extreme lows. When TRIN drops to 0.4 or below, indicating extremely light selling pressure and complacent buying, we still see strong returns of 16% with a 97% win rate. The key difference is timing. High TRIN outperforms at shorter horizons. The contrarian edge is most pronounced in the 1 to 26 week framework. This makes it particularly valuable for tactical positioning and market volatility spikes. When we're seeing across these three indicators, AAI investor sentiment, VIX, and TRIN, is the same fundamental truth. Extreme emotions create opportunities. The beauty is that each indicator captures different aspects of market psychology, giving us multiple ways to identify when these extremes are reached. Now let's move beyond pure sentiment indicators to examine how market structure itself can signal emotional extremes, specifically through yield curve behavior. The yield curve provides a different lens on market psychology, as it reflects how investors are positioning themselves for the future. When fear dominates, money floods into long-term treasuries, creating unusual yield curve shapes that often coincide with major market opportunities. Extreme inversions, when the 10-year treasury yield minus 2-year spread goes deeply negative, the contrarian signals are mixed. These inversions cause short-term pain, but deliver long-term gains that are roughly on par with the historical market average. The most inverted curves in the bottom 5 percentiles had averaged 9.8% returns over 52 weeks, with a 70% win rate, despite initial weakness in the first 1 to 4 weeks. However, the March 1980 extreme inversion of minus 2.41% delivered 29.4% returns in the following year. But here's the strongest signal: ultra-low 10-year yields. When the 10-year treasury yield drops to 1.64% or below, it signals extreme flight to safety behavior. This has been our best performer, generating 16.5% average returns over 52 weeks with an 85% win rate over 6 months and 74% over 1 year. Remember August 2020, when yields hit 0.52%? That generated a 33.8% forward return. The most reliable pattern, though, is steep yield curves, where long-term yields are significantly higher than short-term yields. When the 10-year minus 2-year spread reaches the 95th percentile, this shows the most consistent performance with a 96% win rate over 52 weeks, lower volatility, and the best risk-adjusted returns across all scenarios. These yield curve extremes work because they capture institutional positioning and fear in ways that sentiment surveys can't measure. And finally, let's look at one final indicator that captures market sentiment through breadth analysis, the McClellan oscillator. Think of the stock market as a battlefield where advancing and declining stocks tell us who's winning, the bulls or the bears. The McClellan oscillator helps track this by measuring the difference between the number of stocks going up versus those going down on an exchange like the NYSE. However, rather than just looking at raw numbers, it smooths the data using 2 exponential moving averages, one short term, 19 days, and one long term, 39 days, to capture momentum. When the oscillator is above zero, more stocks are rising than falling, signaling bullish strength. Below zero, bearish momentum takes over. Extreme readings can indicate overbought or oversold conditions, warning of potential reversals. More than a daily signal, the McClellan oscillator reveals what's happening beneath index movements. It's a powerful lens into market breadth, helping investors see the true health of a trend. When this indicator drops to extreme oversold readings of minus 425 or below, it signals that the selling pressure has become so pervasive across the market that far more stocks are declining than advancing, a sign of broad market distress. Here's what makes this indicator so powerful. Extreme oversold readings have delivered a perfect 100% win rate over 6 months with 18% average returns. We've seen this 39 times since 2010, and the one-year returns have averaged an impressive 27.8%. But what's truly remarkable is the consistency across completely different market cycles. During the 2000 to 2012 recovery period, extreme readings delivered 100% win rates with 10% average 6-month returns. During the 2013 to 2015 taper tantrum period, again, 100% win rate with 12% average returns. Even during the volatile 2020 to 2022 pandemic era, the pattern held. 100% win rate with 30% average 6-month returns. This demonstrates the power of measuring sentiment through actual market breadth. When selling becomes so widespread that the vast majority of stocks are declining rather than advancing, it creates mathematical mean reversion opportunities that have proven remarkably reliable across all market conditions. Now you've seen the power of individual sentiment indicators. But here's where AAII Sentiment Investing really shines. We bring all of these powerful signals and more together into a single comprehensive dashboard. This isn't about having access to one or two indicators. We're talking about decades of uninterrupted data across multiple categories of market psychology. For investor sentiment, we have the AAII Investor Sentiment Survey with 37 years of weekly data, the longest running individual investor sentiment survey in existence. This is your peers telling you exactly how they feel about the market every single week. For market sentiment, we track the yield curve with 49 years of data, giving you insights into institutional positioning and fear that most investors never see. Market breadth comes from multiple NYSE indicators, the advanced decline line, ARMS index, and new highs, new lows, that capture the real-time flow of money across thousands of stocks. Market volatility is measured through 35 years of VIX data from the CBOE, your fear gauge that we've already seen work so powerfully as a contrarian indicator. We also track market trends through 97 years of S&P 500 data and market valuation using Shiller's CAPE ratio and Fed model data spanning 55 years. The beauty of having all of this data in one place is that you're not relying on a single signal or hopping to different websites and data sources. When multiple indicators align, when sentiment is extreme, volatility is spiking, and breadth is deteriorating, that's when you have your highest conviction opportunities. No guesswork, no emotional decisions, just data-driven tactical positioning. So here's what your Sentiment Command Center actually looks like. This is the dashboard that puts decades of market psychology data at your fingertips. Look at the left navigation. Every indicator category we discuss is organized and easily accessible. Investor sentiment with AAII survey data, market sentiment with short interest diffusion and yield curve, breadth analysis with the NYSE indicators, advanced decline line, ARMS index, new highs, new lows, market volatility from the VIX, market trend, and market valuation. At a glance, you can also see the mood of each of these indicators with our Christmas tree color readout. You have dark green, light green, white, orange, and red. But here's what makes this truly unique. See this gauge right here in the middle of the screen? This is the AAII Contrarian Sentiment Indicator, which as of last Thursday was at 57.9. This isn't just raw data. Right now, it's telling you that sentiment compression, the convergence of bulls and bears, has collapsed to just 40% of historical norms. The market has achieved a sort of delicate equilibrium. Notice here on your right, you're getting contextual analysis. Markets have achieved a delicate equilibrium with sentiment indicators converging near their historical medians while technical trends remain constructive. This isn't just numbers, it's actionable intelligence. The gauge itself shows you exactly where current investor sentiment sits relative to the fear to euphoria spectrum. At 58, we're in that neutral zone, not an extreme that demands immediate action, but positioned where we need to watch for the next move towards either fear or euphoria. And then you can see the AAII Investor Sentiment Survey right there on the dashboard. The actual current survey data that drives these readings. This is your one-stop command center for reading market psychology, with everything organized, analyzed, and ready for tactical decision-making. Now let me share with you the secret sauce behind the gauge that you just saw, AAII's proprietary contrarian sentiment indicator, which I developed from 37 years of investor psychology data. This isn't just another sentiment reading. The AAII Contrarian Sentiment Indicator is built on our weekly investor sentiment survey and tracks shifts in individual investor psychology and market expectations across nearly 4 decades of history. Here's how the contrarian logic works. Extreme bullish readings above 60% often coincide with market tops. That's when everyone's already bought. Extreme bearish readings below 20% frequently mark market bottoms. In other words, maximum pessimism equals maximum opportunity. It works because retail investors tend to extrapolate recent trends into the future, buying high and selling low. But we've gone beyond simple contrarian signals to develop a sophisticated analytical framework. We track sentiment compression. When bulls and bears converge, volatility expansion often follows. We monitor participation dynamics. High engagement, the total percentage of bullish and bearish investors, with low conviction, the bull-bear spread, signals fragile consensus that can break quickly. We measure state velocity. Rapid sentiment transitions indicate unstable market equilibrium. And we watch for neutral surge. Rising neutral sentiment or indecision above 30% often precedes major market inflections, with investors poised to either buy or sell. The strategic value for investors is enormous. This provides market character assessment beyond simple bull-bear classification. It reveals when consensus is both strong and fragile, prime conditions for reversals. It helps identify periods of stored energy in compressed sentiment environments. Most powerfully, when combined with technical and fundamental analysis, you get the complete picture of where markets really stand psychologically. What is the true value add to this dashboard? The AAII Contrarian Sentiment Indicator is available exclusively to Sentiment Investing subscribers. This slide highlights where our months of AI development really pays off for you as an investor. While other platforms might show you a VIX reading of 35, AAII Sentiment Investing tells you that historically, VIX spikes above 35 have been followed by positive returns 89% of the time over the next 6 months. When you see bearish sentiment hit extreme levels, our AI doesn't just flag it as oversold. It tells you that similar readings in 1990, 2002, and 2016 were followed by average gains of 18% over the following year, and then walks you through what made those periods similar to today. The real value is in the pattern recognition across multiple timeframes and market cycles. Our AI can instantly identify that current conditions match 1994's taper tantrum, or 2011's European debt crisis, or 2018's trade war sell-off, and explain why these historical parallels matter for your portfolio in the decisions you're making today. Most importantly, it connects the dots between different indicators, Instead of looking at sentiment in isolation, it shows you how current readings interact with valuation levels, market breadth, and volatility, creating a complete picture of market psychology unrivaled in the marketplace today. This isn't just convenient, it's a genuine competitive advantage. While other investors are flying blind or spending hours trying to piece together historical context, AAII Sentiment Investing gives you sophisticated analysis that turns decades of market wisdom into immediate, actionable insights. Now let's talk about how you actually use all of this data in practice. The benefit of sentiment investing is that it doesn't require hours of analysis. Just a quick, simple 5-minute weekly check-in. Here's your framework. Start by checking the AAII Contrarian Indicator reading to see where overall investor psychology stands. Next, review the bull-bear spread for trend confirmation. Is sentiment moving toward or away from extremes? Then confirm with market breadth indicators like the advanced decline line and new highs, new lows to see if sentiment is supported by actual market action. Consider valuation context using CAPE and Fed model data. Extreme sentiment matters more when valuations support the story. Read the AI-assisted analysis that tells you when we've seen this before. This gives you a historical perspective by doing the research for you. Review what actually happened during similar conditions in the past, and this calibrates your expectations. Finally, make tactical adjustments within your existing strategy. However, remembering that this is more about tilting, not transforming your approach. The key is consistency and discipline. This isn't about making dramatic moves based on every sentiment reading. It's about developing a systematic way to read market psychology and positioning yourself for the opportunities that emotional extremes create. Most importantly, you're not abandoning your fundamental investment approach. You're enhancing it with insights into when the crowd's emotions are creating tactical opportunities that disciplined investors can exploit. This is the slide that brings everything together. How you actually implement AI sentiment investing in your portfolio. Notice the headline, tactical adjustments, not strategic overhauls. This is the most important concept to understand. You can use sentiment to make tactical tilts within your existing investment framework. If you're normally 60% stocks, 40% bonds, sentiment might tell you to go 65% stocks when fear is extreme, or 55% when euphoria peaks. You can keep your strategic allocation intact. Sentiment doesn't change your fundamental approach. For tactical implementation, you make small temporary adjustments to allocations. We're talking maybe 5 or 10% moves, not wholesale portfolio changes. These adjustments revert to strategic weights over time as sentiment normalizes. You don't rely on a single indicator. You want multiple signals confirming the same story. And you set clear rules for when to tilt, so you're not making emotional decisions at the moment. Here's the key insight about your goal. You're trying to lower volatility, not necessarily boost absolute returns. AAII Sentiment Investing can improve your risk-adjusted returns by helping you avoid the worst drawdowns and participate more in recoveries. Think of it this way. AAII Sentiment Investing wasn't designed to help you beat the market by 500 basis points every year. Instead, it's intended to help you smooth out your returns by being a little more aggressive when others are fearful and a little more cautious when others are euphoric. Over time, that discipline creates better risk-adjusted performance and helps you stick to your long-term plan. Now let's get a quick read on where you stand now that you've seen the full sentiment investing platform. So I believe Jenna is going to deploy another survey that's going to appear on your screen. And what we're asking here is, what excites you most about having all of this data integrated into one comprehensive system? Is it the exclusive contrarian indicator that you can't get anywhere else? That proprietary gauge I developed from 37 years of AAII sentiment data? Maybe it's simply having all of these powerful indicators in one place instead of hunting across multiple websites and data sources to piece together the market psychology puzzle? Could it be the weekly expert analysis that saves you hours of research for providing professional level insights? Perhaps it's the decades of data history, having access to market psychology patterns that most individual investors never see. Or is it the special pricing we're offering today for this new product launch, which we will unveil shortly? Take a moment to think about which aspect resonates most with your investment approach. This is your opportunity to introduce a sophisticated layer to your investment process that many professionals lack access to. So what's driving your interest the most? And we'll give you just another minute or so, and then Jenna will deploy the results.
We have about 54% participation right now, so please get your votes in before I close the poll. We appreciate everyone for participating today.
Absolutely.
All right, we're about 66, about 70% voted now, so I'm closing the poll. I'm going to share the results. So the results are, the winner is 60% is all indicators in one place. The runner-up is 20% weekly expert analysis, and then 10% the exclusive contrarian indicator, 8% decades of data history, and 3% the special pricing. Excellent.
And that makes sense. I think I'll probably allude to it in just a few moments, but the one thing about AAII Sentiment Investing is you get all of these indicators in one place, and you see the history behind these indicators. There's a lot of dashboards out there. CNN's Fear and Greed gauge comes to mind. All they give you is the current reading. You don't see a history, and you certainly don't see the history of any component variables that go into it. We're giving you literally decades of data for all of the indicators that we're providing. And so I think that's really the one key differentiator between all the other services out there in AAII Sentiment Investing, is you get that history, not just that single current point in time. So to recap, here's exactly what you get with your Sentiment Investing subscription. Remember, this is a comprehensive system, not just a data feed. You get the real-time sentiment dashboard with over 10 indicators and counting. We anticipate adding more shortly, all integrated in one place. No more hunting across multiple websites or having to piece together different data sources. The exclusive AAII Contrarian Indicator is yours. This proprietary calculation is available nowhere else and gives you a sophisticated read on market psychology that no one else has access to. Your subscription includes 37 years of AAII sentiment data, the longest running individual investment tracking system in existence. This historical data is what makes the patterns so reliable. All the market breadth indicators are included: advanced decline, trend, and new highs and new lows data going back to 2009. Market sentiment indicators, including short interest diffusion and yield curve data since 1976. For volatility and trend analysis, you have access to VIX data since 1990 and S&P 500 trend analysis data going back to 1928. Valuation metrics include CAPE and Fed model data since 1970. However, what really sets us apart is the inclusion of AI-assisted indicator analysis, featuring historical pattern recognition and, when we've seen this before, contextual insights. Additionally, comprehensive historical databases for all the indicators allow you to view the long-term patterns yourself. You can find current readings of many of these indicators at other locations, but few services offer the data to do your own analysis, let alone for free. We've also included an educational resource library to help you master sentiment investing techniques, and everything is designed with a mobile-friendly interface so you can check market psychology anywhere. This isn't just data. It's a complete tactical intelligence system for market psychology. As we wrap up today's presentation, let me tie together the key insights we've covered about mastering market psychology as a tactical tool. We started by seeing how investment sentiment data, especially at extreme levels, offers genuine insights for market direction. The statistics don't lie. When the VIX hit panic levels above 40, we've seen 97% win rates over the following year. When AAII Sentiment reaches extreme bearish readings, average returns jump to over 24%. These aren't coincidences. They're predictable patterns in human behavior. However, sentiment data should always be used in conjunction with other indicators. That's why AAII Sentiment Investing integrates multiple signals: sentiment, volatility, breadth, valuation, and trend analysis. When these align at extremes, that's when you have your highest conviction opportunities. Now, I fully admit there's no such thing as an infallible indicator, and sentiment investing is no exception. This is about improving your odds and making more informed tactical decisions, not about perfect market timing. Even our best signals work 85 to 97% of the time, not 100%. Most importantly, sentiment data can help you avoid the herd mentality and maintain a contrarian outlook when it matters most. Remember those AAI members who went from 77% stocks at the 2000 peak to 44% at the 2009 bottom? That's the herd mentality in action. Finally, having a plan in place is critical to avoid emotional decisions that can destroy wealth. That's what AAII Sentiment Investing provides: a systematic framework for reading market psychology so you can be tactical when others are emotional, disciplined when others are reactive, and opportunistic when others are fearful. The choice is in front of you now. You can continue making investment decisions the way most people do, based on emotions, headlines, and gut feelings, or you can start making emotion-free decisions backed by decades of market psychology data. You can join AAII Sentiment Investing today and save $50, just $149 for your first year, compared to the regular price of $199 a year. That's access to 37 years of sentiment data, our exclusive contrarian indicator, AI-assisted analysis, and a complete tactical intelligence system for less than what you may spend on Netflix or Hulu each month. Visit aai.com/sentiment-special to get started today. Now remember, this is a special pricing that has a 48-hour deadline. After that, it goes back to the regular $199 price. And we're backing this with a 30-day money-back guarantee. If AAII Sentiment Investing doesn't enhance your investment process, you get your money back, no questions asked. Think about what I've shown you today. The statistical evidence is overwhelming. The question isn't whether market psychology creates opportunity. The data proves that it does. The question is whether you'll have the tools to recognize and act on those opportunities when they arise. Don't let the next sentiment extreme catch you unprepared. Start making emotion-free decisions today at aai.com/sentiment-special. Thank you very much.
Hi, Wayne. We have a lot of questions coming in.
Hello, Jenna.
Excellent. Okay, let's see. We have a lot. So I did put in the chat that if we do not get to your question, just because we've had so many great ones come in, please email members@aaii.com, or if it's very specific to a sentiment indicator, you can also reach out to Wayne directly at wayne@aaii.com. But we're going to start off right off the beginning because we have quite a few people who have shared with us that they have not used sentiment data before, that they're strictly fundamental analysis or strictly technical analysis. So if you were to give any tips or tricks to a beginner that has not used sentiment data in their strategy before, where do they start on the website? Do they vet their current stocks? Do they look at new opportunities? They use the data for new opportunities. Where should they start?
Well, this is giving you context for the market in general. So that's the most important thing. I want to point out again, this is not a market timing tool. What this does, I think, especially for people that are new to sentiment investing, I think the best way to look at it is you can use AI sentiment investing to frame your expectations. If you start looking at data and you start looking at the data and you see that market breadth is deteriorating, either bearishness or bullish sentiment is hitting an extreme, You see that currently the CAPE is at some of its highest levels since the dot-com boom. All of those things allow you to frame your expectations of what might be, and the key word is might be happening going forward in the market. So I think that's the biggest thing, is by framing your expectations, that is a great way to sort of rein in your emotions. If you look at the data and it tells you, historically, this is pointing to either a surge in the market or a drop in the market, you're already able to start preparing yourself for that. And that's maybe where you might start thinking about making some small tilts to your portfolio. It's either, either pulling back from stocks or increasing your allocation to stocks, and vice versa with bonds. So I think this data really is a great way to frame and manage expectations. And if once you're, I know at least for myself, is if you're managing your expectations, you're much less likely to sort of hit emotional extremes. If you expect something to be happening and it does, it's like, okay, I was preparing myself for that, versus all of a sudden, you're caught unawares and it happens. That evokes a very different emotional response. So I think that's probably the biggest thing, is you can get a very good idea, again, looking at, because our indicator analyses, our AI generated indicator analyses will show you, we've seen this before, and this is what's happened after this has happened. Obviously, the huge caveat there is, past performance is no guarantee of future performance. But when it comes to investing, really all we have is history to go on. So again, it's managing your expectations. These aren't infallible. Just because investor sentiment is hitting the extreme. Obviously, the March 2009 example, you couldn't have asked for anything better than that. Bearish sentiment bottomed out 4 days before the S&P 500 bottomed out. It's not going to happen every time, but it happens. If you look at the history, it happens. Within maybe several weeks or a couple of months. You don't know when it's going to happen, but it's coming. And history has shown that over and over, when it hits these extremes, it does happen. So I think the greatest, the way that I really use this data the most is managing my expectations on where the market might be going in the future.
That makes sense. That's an excellent explanation. And we had a lot of people, asking, they're very interested in the indicators. So how often are the indicators updated?
So the NYSE indicators and the VIX, those are updated daily after every trading day. All of the AAII sentiment data, so the contrarian indicator, the bull-bear spread, the AAII sentiment trend, that data is only updated weekly. So that the analysis and the data behind those are updated every Thursday morning. Everything else is typically updated weekly on Saturday morning. So you get kind of a mix. It ultimately is depending on how quickly things move. The breadth indicators can be moving very rapidly. So those are being updated on a daily basis. AI sentiment data is only weekly, but we then update the analysis weekly. But then things like short interest diffusion, the CAPE ratio, things like that tend to move a little more slowly, that's only updated weekly.
Okay, excellent. And we have a lot of, people asking, whether or not, how come this indicator wasn't added, or how come you looked at certain ones? So can you give some, I guess, background on why or how the current indicators that are on the sentiment investing dashboard were chosen?
We tried to get a good cross mix of, different areas of market psychology. So we're looking at volatility. Obviously, we have the AAII investor sentiment. We wanted to look at market sentiment, market valuation. So, probably our first brainstorming list, we probably had 20 or 30 indicators. And as I alluded to in the presentation, we plan on adding indicators over time. It was just, it was the ones that are most often quoted in the financial press. Also, it was working with our data vendors. Some indicators are not available for a reasonable price, even to organizations such as AAII. One that comes to mind is the put call ratio. that is an incredibly expensive piece of data to be able to acquire. So it was kind of a mix of, we wanted to have, at least to start, a good cross-section of market psychology to look at. Then it was what's available to us through our current data vendors, or that our current data vendor was willing to add to it. And then it was, some were just, not were cost prohibitive even for us, even for a premium product. So, but again, over time, we're going to be adding more and more variables. So, this is not by any means our measure of what we consider to be the be-all, end-all of indicators. Those are the ones that we've at least started with.
Makes sense. Excellent. And we actually had a lot of people come kind of talking about how they're a long-term investor. How do I use this? So how often should you check the dashboard, and how long or how often should you be aware of that when indicators change or things like that? And then how do you respond as a long-term investor?
I would say realistically, probably this is something you'd visit every weekend. If you're really interested in the AAII sentiment data, then you might want to visit Thursdays, mid-morning, when all that data in the analyses is updated. This is not something that you're obsessing over and returning to on a daily basis. The more you obsess over it, the more apt you are to become emotional and make those decisions that destroy wealth. So I would say this is something you're looking at on a weekly basis, whatever the cadence is that works best for you. But again, it's all about framing expectations. It's, like I use, put it in a way that maybe more people understand is, I'm definitely a fundamental investor. I run my fundamental screens. I do my fundamental analysis to look for stock ideas. But, I'm also a fan of technical analysis. I am not a day trader. I'm not a swing trader, but I understand that there are patterns that show up using technical analysis that can potentially allow me to find better entry and exit points. So I use those tools. You view sentiment investing as exactly the same way. Is, if extremes are being hit across multiple indicators, it's not saying that the market's going to do this tomorrow or even the next day, probably. But it tells you that the setup is there, that very shortly, history has shown that something is going to happen in the marketplace. And it establishes that baseline for you, and it helps you manage your expectations to remove, hopefully, some level of emotional reaction to when things actually do happen. So I think that's the best way that long-term investors can use it, and that's the value that sentiment investing provides to longer-term investors.
Excellent. And I saw a couple questions that came in kind of similar, asking, you touched actually on this earlier in your presentation, but for those who join maybe later, what really makes the AAII Sentiment Investing dashboard stand out, or specifically the contrarian sentiment indicator stand out versus other on the market? So similar to like fear and greed or something like that.
I think first and foremost, it's our AI generated analysis. You can get a very basic glance of the market mood looking at CNN's fear and greed tool. You're not getting the level of analysis that you're getting to say, this is what's happening currently. These are historical constructs that have happened that sort of mimic what's happening now. When these similar things have happened in the past, this is what the market has done going forward. I think just our AI generated indicator analysis alone is basically unparalleled of most things that are available to tools geared specifically to retail investors. I'm sure that there are institutional tools out there costing significantly more than $149 a year that do this and more. But for a retail investor looking beyond just, this is what's happening now, I don't think there's many tools out there that offer the level of in-depth analysis and collection of tools and indicators that the AAII sentiment investing offers.
And I actually saw a really good question came in, and they were asking, is there a reason why AAII saw a need for a sentiment tool now in 2025? Is it because we saw so much volatility in the beginning? Was it something that we had, just been in the back of our minds that we wanted to create over, a number of years? What was kind of the reason or the goal that caused us to kind of create this product?
I mean, AAII has been publishing its investor sentiment survey since 2 months before Black Monday, actually, of 1987. And I've been looking at the sentiment survey data for a long time, and these contrarian signals that it's generated over history have been quite powerful and quite remarkable. And I think it was basically, this is kind of a growth from that. Is we've known, perhaps anecdotally, that extremes in investor sentiment normally coincide with inflection points in the marketplace. And so we said, okay, we have this sentiment data, to provide that is nice, but then we started thinking, well, because there is no indicator is infallible, and no one should be relying on one indicator alone. So we wanted to create basically a diversified tool, a diversified collection of market psychology indicators. And so that was basically, we knew we wanted to build something around our longtime investor sentiment survey, but then understanding that you want to have multiple indicators giving you that confirmation, that's what then it grew into these 10 plus indicators currently that became ultimately sentiment investing.
Excellent, excellent. And we'll just take one last question. Let me see. So it looks like, actually quite a few questions similarly is, when you subscribe, when do the reports come out? When do your insights come out? What can they expect as a subscriber of what they get each week, or what kind of communication you provide them with?
Certainly. So, currently it's me. Every morning around between 7 and 8 a.m., I'm running these analysis using LLM models to create our daily indicator analyses. So typically you'll see the indicators that are being updated on a daily basis. The new daily analyses should be appearing probably around 9 or 10 at the latest Central Time. Every Thursday, you'll see the AAII sentiment data updated on the website, as well as then the respective analyses regarding that. Again, probably around 7 or 8, 9 o'clock Central Time. Then each Thursday, all sentiment investing subscribers will receive my sentiment insights newsletter via email. It's also posted on our website. Basically, looking at all of the data that we have and trying to find parallels. Basically, see what does it all mean? Distilling all of that down into a structured discussion of, this is what all of these different indicators are telling us at this point in time. That goes out by email Thursday afternoons. It's also updated on our website. And then again, typically sometime over the weekend. I do try to do it first thing Saturday morning, but sometimes life gets in the way. But normally then sometime on the weekends, you'll see basically everything updated except for the AI sentiment analyses. Sometime on the weekend, then you'll see everything updated once again.
Great, excellent. Thanks for kind of outlining what people can expect. I think that really helps. And I want to say thank you first, to Wayne for such a great presentation. I think, everybody had some great questions, and they were really interested in, finding out how they can not only interpret and apply the data, but also use it alongside their already, their strategy already that they have. And then I just wanted to give you some time, before we go over final reminders and information. Are there any last thoughts or comments you want to leave the audience with, Wayne?
Well, thank you to Jenna. She always is a fabulous showrunner. She always makes us look good. So thank you very much, Jenna. I appreciate it. And just, I want to say, if anyone's questions weren't answered, obviously anything specific to a subscription itself, you want to feel free to reach out to members@aai.com. But if you have any questions regarding the indicators, our AI generated analysis, anything like that, that's more of the sort of the meat and potatoes of AAII Sentiment Investing, feel free to reach out to me at Wayne, W-A-Y-N-E, @aai.com. Otherwise, at a minimum, again, it's a risk-free opportunity for you. So I hope you take a look. I'm very proud of this product. The AAI team did a wonderful job coming together to create this. I'm so excited about our website. So try it out. It might not work for you, and that's fine. But definitely see if it does somehow offer you, again, being able nothing else, to be able to ground your emotions, even if you're a long-term investor. But with that, again, thank you everyone for attending today. And Jenna, thank you very much. And with that, I'll turn it back to Jenna, but I hope everyone has a wonderful afternoon. So thank you.
Thank you so much, Wayne. And like I said, I tried to put as many of the resources that we mentioned, emails, the promo, everything into the chat. But we will also compile everything into a nice email and send that out to all who attended today. But I want to just kind of reiterate that please visit AAII.com/sentiment-special to sign up with our special discount. And then, like Wayne said earlier, this is a limited time pricing only available to those who attended today. If you have questions, we're of course here to help. Feel free to email us at members@AAII.com, or you can call us at 312-676-4307. That's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then, as Wayne mentioned, if it's specific to the sentiment indicators or any kind of insights or anything, please email Wayne@AAII.com. Lastly, I know we got a lot of questions about this. The presentation was recorded and a replay will be available at AAII.com/webinars later this week. Webinar attendees will receive an email with the link in the next few days. You'll also receive a copy of the presentation slides, as well as links to other resources. Anything that we discussed today, we'll include that in that email. And with that, we wish all of you viewing good health, good fortune, and a great rest of your afternoon. Thank you so much and take care.